Welcome, everybody. Welcome to our live webinar, Ask ProVisor. My name is James Mercado. We are offering transparent talks to real estate professionals. I'm the president of ProVisor. We've been around for a long time, been in the business over 25 years. And I've had some people ask me, why are we doing this? Well, we want to help differentiate our real referral partners, our real estate agents, our realtors, and we want to help them bring value through expertise and knowledge so they're better equipped when serving their clients in this market. The market's tough right now. And we all find ourselves trying to navigate through this, and knowledge is power. We want to empower those people to have the knowledge so when they're in the field, they are confident with what they're dealing with, and we're available to answer any questions. But that's really why we're doing this. We want to just bring more information to help us all do a better job. If you have any questions, you can post it in the chat, or you can send an email to james@provisor.com. We do take live questions during the show. And today I have we have a special guest today. His name is Ritchie Baumann. Ritchie's been with ProVisor a long time. He is one of the top producing loan officers in the state of Wisconsin. He is one of the top producing loan officers even at ProVisor. He is very knowledgeable. He is an expert. He's deemed an expert by many real estate professionals that will call Ritchie and say, Ritchie, this lender screwed up this deal. I know you're the smartest guy. And he has got a reputation where he figures stuff out and gets those tough deals done. Now, granted, he likes the easy deals too, all right? But he has become an expert in dealing with difficult loans, and he understands the guidelines. He understands the rules that underwriters operate under. And if he doesn't know the answer, he knows how to get the answer. So I'm very excited to interview Ritchie today. He's also going to be asking me some questions today. So Ritchie, tell us a little bit about yourself, for those who don't know you.
So I've been at ProVisor for 12 years, helping do loans. Tell me about myself. I mean, it's weird. Because we're going to talk about, I don't know. Yeah.
I'll talk about Ritchie. Ritchie's an amazing guy.
You caught me off guard.
Well, you're a humble guy. You're an amazing guy. And he's always willing to help. He's a servant at heart. So if you are a real estate agent and you have a client, and even if you're not doing the loan with Ritchie, but something doesn't seem right, I can tell you, I can vouch for Ritchie's character. Call him. He'll answer the question, even if he's not doing the loan. Ritchie's a big believer in leading with a giving hand. So even if you're like, you know what, the loan officer's telling me this, Ritchie, I don't know, does that seem right? And here's a perfect example. Somebody just put in the chat, Ritchie's the best. So there, I bragged on you for yourself, Ritchie. All righty.
Thanks.
You're welcome. So we're going to get into the questions now. Ritchie had a few questions that he wanted to ask me, but we're going to put those off for a little bit because I want to continue to ask Ritchie some questions and make him blush some more. Okay. All right, let's jump in. Let's talk about the term lending guidelines, overlays, the rule books. Why are they different from HUD to VA to USDA to Fannie Mae to Freddie Mac? I mean, how does this information even help a real estate agent, Ritchie?
Yeah, so I'm passionate about this topic and making sure people understand it because it is a differentiating factor. And to help you all as help the real estate agents, I'm just kind of open it with, here's how I explain it to customers. And then we can talk about specific examples to help them understand how they're there. So, here's what it is. There's 5 main loan types: Fannie Mae conventional, Freddie Mac conventional, FHA, Federal Housing Authority, VA loans for veterans, and the USDA rural housing loans. That's the 5 main loan ones. They each have a rule book individually for them, and it's the same rule book for the entire country. Why they get to write the rule book is because they insure the loan for the lender. That's ultimately what lenders want to have happen in case of foreclosure. They've got some insurance to recoup their expenses? Well, since they're going to insure it, they write the rule book. They're pretty specific about the rule book that is offered, like FHA. I think it's like 1,600 pages in that rule book. They've thought of everything. And they don't make a special rule book for anybody in the country. It is the same rule book, the entire United States. However, any individual lender can take any rule in that rule book and make it tougher based upon their tolerance for risk. I call it an overlay. Here's the rule book. Okay. They lay an extra rule over top of it for their tolerance. And that's what we want to really talk about in this first part, is because this thing differs by lenders, and which could, for real estate agents, for you all, it could differ what happens to your customer depending on what lenders they talk to.
Okay. So how do I know, Ritchie, if I'm a real estate agent and I'm working with a borrower and that borrower's got a pre-approval from Acme Mortgage, and then they got another pre-approval from, XYZ Mortgage. How do I know as a real estate agent that the extra rules that you're talking about, which lender has those and which don't? How do I know that?
I think if they're pre-approved, I do think it's going to be tough for them to know, because you would think that loan officer at least has, if they've done it right, has pre-approved them based on the extra rules they have in their their organization. They don't pre-approve them to the actual FHA rules. They pre-approve them to their overlays. Where I think the realtor is going to know whether or not an overlay is affecting them is when their customer gets told no. Or their customer gets told they've got to wait, or their customer gets told, do this or do that before we can do certain things. And that is when real estate agents, the trigger should go for you. I wonder if this is the actual rule that I learned from Ask ProVisor, or is this an overlay? So then the question goes back to the loan officer that's telling the realtor's customer no, is saying, the realtor asked the loan officer, is this the actual rule out of the rule book, or is it your overlay? And if they can't even know whether the difference is, you're probably in an overlay situation, in my opinion.
So typically, if a loan officer is working for their company, they may not have access to the rule book, and they may just be taking what their manager or what the underwriter is telling them, that this is our rule. So therefore they equate that to be Fannie Mae's rule. True?
Yeah, true. Because I'm going to go back to when I started.
Yes.
As a real estate agent, you started one day and you didn't know all the rules for what your career was. I didn't know all the rules for mine. And so I just did what I was understanding. And then all of a sudden, one day, I remember a call-in came to the company and this person said, yeah, I went to this lender and they told me no, but I really need a house. So I kept searching and I found you. And I'm just wondering, any shot you can help me. And I still remember the question. I said, why did they tell you no? Well, because my 647 credit score was too low. I'm like, what? We were doing, I was like, we can do that. I didn't understand. And I remember talking with you going, James, what's going on? Well, how did they get told 647 is too low? And that's where the overlay world started to come to light. And, the loan officer just tells them like it's too low. They don't explain whether it's the rule book or the overlay, and shame on the industry for not doing that.
So it's not only is it possible, it's probable that some loan officers don't even know the difference between their company's overlays and the actual rule book.
That is highly possible, and I think it happens more than the industry realizes, because let's be a loan officer that here's this customer and they got to tell them no. And I'm not saying loan officers are consciously doing this. They just don't know they're doing it, but they're saying no because they don't want to tell them, hey, oh yeah, I'm sorry, Mr. Borrower, I can't help you with the loan. But if you call somebody else, they probably can. Nobody wants to do that.
Right.
I've learned that has benefit if you actually tell the borrower when you tell them no, it's the actual rule or if it's one of your overlays. And there's some value in that.
Okay. Let me ask you this question. Why do some lenders have overlays?
It's risks, it's tolerance for risk is how I explain it. So I know we're going to talk about some specific ones here a little bit, but imagine, you know, a borrower has to repay their mortgage. That's why we give them one. And some people are willing to jump off of a diving board that's 3 feet tall, and some people are willing to jump off a diving board that's 10 feet tall. They have different personal fear factor in them of how high they will jump into a pool. It's kind of like that for mortgages. Lenders have different tolerances of risk they will take based on historical data that they probably have for performance of a loan being paid back so they don't have to go through foreclosure. And I think the other part they've got these things exist is when they want the VA or the FHA to ultimately insure the loan, that's the ultimate goal real estate agents need to understand is it's not that people don't want buyers to have loans. It's the insurance policy that every lender wants to have. Well, if underwritten the loan's closed, there's more audits that happen after the loan closes. And I don't know if real estate agents all know that there's ultimately the last audit is let's just use the FHA again. The FHA looks at the loan from a lender and makes sure they followed the rule book. If they didn't, the FHA is not going to insure it. Doesn't affect the homeowner at all, but it affects the lender. So I think lenders put overlays in because if they have the overlay, but they messed it up and they're off by a little bit, well, they still got a cushion that the FHA will still insure it. I think that's one of the reasons.
I would agree. Over the years, when loans go in default, when a HUD loan or FHA, go back to 2008 during the Great Recession, a lot of loans went into default foreclosure. The HUD can actually go back to the lender years later. So a lot of realtors may not understand this, but they can go back to the lender and say, hey, you approved this loan 3 years ago. We audited the file because the file went to foreclosure. You made these mistakes. Now you have to buy the loan back from us. And lenders lost tons of money during the Great Recession because of sloppy underwriting. And years later, they came back and said, hey, I know this loan closed in 2004 and it's 2008, but it's in foreclosure and you didn't follow this, that, or the other. And now write us a check for $280,000. And that put a lot of lenders in a bad position, and hence it's spiraled out of control. And there's bankruptcies like crazy from mortgage companies. So
I've explained this to real estate agents and to help you all understand kind of our world and how, it can sound annoying that a lender keeps asking for this document or that document or critiques the house like this or critiques the house like that. And ultimately, and you shared this with me, and I didn't know it till years later, with my license number, the FHA actually tracks all the loans I originated. And if too many of the loans Ritchie Baumann originated, go to foreclosure, does not matter the reason. If they just go to foreclosure, I can lose my ability to originate an FHA loan. And that can follow years later, right? That's how we talked about that?
Yes. Unfortunately, they track it. Now, that was after the Great Recession where they started tracking those loans directly to the loan officer, not just the company. So loan officers are held accountable and the companies are held accountable. So there's a dual accountability now, that never existed before until after the Great Recession. We had one of our viewers just made a comment. I just want to read this to him. She said, this happened to me with a client working with their local bank. They were told their income was too high to do an FHA loan. Then she explained the overlay and suggested going to a different lender. And I'm assuming that after she did that, they found another lender and closed the loan and got their house. So, right. That happens every day. Some lenders are just much more conservative because especially after the 2008 crash where they had to buy a lot of loans back. I was talking to one friend of mine who's the president of mortgage company, and he was telling me that it almost wiped them out because they made some mistakes. They had to buy a bunch of loans back 7 years later, or 5.5 years later. I'm sorry. So it's a real thing. So Ritchie, let me ask you this. All right. Give us a couple of examples of an overlay. So we've got the rule book, then we got the extra rules called the overlays. What are a couple examples for our viewers?
So my favorite one to always say is about credit score.
Mm-hmm.
In the FHA rule book, let's start with that one. If a person has a credit score, the minimum required is 500 middle score.
500.
That is the 500 middle score FHA loan.
Okay, right now, Ritchie, our viewers are probably saying you're crazy because I've been a real estate agent for 20 years, and that's just not true. Everyone knows it's 580 or 600 or 620.
Oh, wait till we talk about VA. It'll be getting crazier in their mind. So, but let me finish the FHA. If a person has no score, like they're just a ghost in the credit world, those are possible too. That's not, so you can do that. We're talking about when they have a score, FHA's rule book is 500. The VA, no credit score limit. You can go as low as the scores go, according to the VA. Now, when we talk about overlays, I don't think we've yet to find a lender that goes below 500 for a VA loan. But the actual VA rule is no minimum required credit score. So that's an example of the most popular one that blows people's mind. And you can help more people knowing that because I know lenders that their minimum required credit score on an FHA loan is 640.
Right. So I'll give you an example. For our real estate agents, I had a loan officer who is a longtime LO, been in the business over 20 years, decent producer, smart loan officer, wants to come work at ProVisor because of our business model, which we'll get into in a little bit here. But in the interview process, we were talking about credit scores, and he looked me dead in the eye and told me I was 100% wrong, that you cannot do FHA and VA loans under 580. And he basically didn't call me a liar, but he said, I need you to prove it to me. So I had to pull out files to show him that we closed FHA and VA loans with credit scores of 507, 523, 540 something. And he's like, and then I pulled out the guidelines. I had to show him in the rule book. And he, big producing loan officer, his company said it is the rule 580, but that was actually the overlay for the company because they didn't want theirs. And mostly even the senior managers didn't even understand that, because most people don't read the actual rule book. They read the company's rules, and the company's rules can have extra rules on top of the HUD's rule book or VA's rule book. So we'll talk about that a little bit later about how ProVisor operates, so our referral partners understand that. But this is just to educate you. If your lender says no, get a second opinion, because each lender has their own set of extra rules that they're allowed to add on, other than discrimination stuff. They can't discriminate against things, but extra rules when it comes to ensuring the money they can have.
And I would also caution or make everybody aware, we've talked about lenders and overlays. Google's an overlay. The Yahoo search engine's an overlay. Understand what those are, because I've had customers where they go and do their own searching and they're like, yeah, I can't get a loan. This is what I found. And I asked them where they find it, and they searched online. Let's remember, the internet has been around for a very long time. And these rule books go through updates. There could be a website out there that could look really official, FHA.com, for example, that's not part of the FHA.
Right.
And they will spell out what the rule supposedly is. And really, it's just a lead generation website that has the overlays, and it's not the truth. So I tell people, like, the actual rule book is public access. You can get to it. A real estate agent can go look it up. It's not fun to read. It's 1,600 pages FHA, 1,000 some pages VA. I think it's 1,200 Fannie Mae and Freddie Mac. I mean, it's long rule books.
Or we can just call Ritchie.
So here's some other, we talked about the credit score. That's my favorite one to talk about because it does blow people's mind. But here's the ones I hear customers getting told no by other lenders. A 2-year work history. I think it's happened twice this year already where the customer said, yeah, my lender said I can't get a loan because I've not been at my current job for 2 years. I said, well, that's false. I explained to an overlay. The actual rule is we have to prove a 2-year work history in life. You know, like I helped a gentleman who he'd been at his current job for, I think, 9 months. He served 12 years in prison prior to that, and he had a job before he went to prison. The job before prison could verify it, that he worked there. It was a doable loan. He worked 2 years in life.
So maybe you didn't go to prison if you're watching this, your customer didn't, but you know, we see this a lot with a stay-at-home mom.
Yeah.
She worked before the kids. Now she's been off work and the lender says, sorry, you got to have 2-year history. And then they come to, talk to you or talk to somebody and somebody else digs in and says, wait a minute. No, it's 2-year life work history as long as it's documentable. So if you go back 15 years ago and you find out that she was a dental assistant, let's just say, and the dentist verifies that from 15 years ago, that works, correct?
Yeah. As long as you can get it verified.
So if you were going to sum it up, Ritchie, and the real estate agent has a borrower that went to pre-approval and they went to their favorite lender or whatever, and the lender says no, what should they do?
They should call another lender. They should call another loan officer. And I know we're going to wrap up mine.
What kind of questions should they ask when they call?
When their customer gets told no at a lender, they should call that loan officer and say, why did they get told no? They're going to explain something and then just ask them, is it the actual rule book from the FHA or VA, or is that your overlay? And as soon as the real estate agent uses the word overlay, most loan officers go, how did you know that word?
True. Yeah. And if they don't know, then they still should go to, they call ProVisor, just ask us. We'll give free information. If you're not sure, call our number 262-754-4444 and just ask the question and we'll tell you if it's a rule or not. Whether you send us the deal or not, we just want to help. We want to be givers. We want to invest in our referral partners, whether we're getting the loans or not. So,
and one more real quick, James, that doesn't have to do with saying no to a customer. An overlay that has affected people even when they got a yes from a lender is debt to income ratio. I've taken several calls where they were approved someplace for $200,000. But where they want to buy, it's just not buying them a house. And so they ended up calling and I explained to them overlays and max debt to income ratio. And all of a sudden I'm approving them for $300,000 because that lender had an overlay to how much of a person's income can be used to pay for a mortgage and debts in life. And again, the VA will shock you. The VA, I've done one at 70-some%.
On a VA loan?
On a VA loan. And, that just approves somebody for more house that way. And it's a very key element that realtors need to understand.
In the next couple of months, we're going to do a whole segment just on VA home loans. You're not going to want to miss it, everybody. The myths around the VA home loan, I'm going to shatter those myths, but we'll talk about that next time. All right?
Sounds good.
All right, Ritchie. Thank you for sharing.
But now it's time me ask you some questions.
I'll go for it. Yeah.
So we talked about this overlay. So now let's talk. We want to ask you, James, because you've structured our company as a certain type of business, and we want to explain to the real estate agents. You may generically use the word lender, but there's really different types of lenders and what they do. Like I've written down the main ones I think of are there's a bank, there's a credit union, there's a broker, there's a non-delegated lender, and there's the delegated type lenders. Would you add any categories to those before we explain them?
No, those are the categories, or those are more, I would say we've got your traditional lending institution, bank, credit union. You've got your retail lending institution, which would be what we call a delegated or captive lender. To use an insurance example, it'd be like a State Farm Insurance or an American Family Insurance. That'd be a captive insurance agent. So that would be your retail companies out there that are they don't have depository accounts like a credit union or a bank. They're a mortgage banker, but they are a delegated version of that or a retail version of that where it's just they're captive. So, and then there's the independent, and there's two types of independence. There's the mortgage broker, and there's the non-delegated correspondent lender.
All right, so let's just break each one down a little bit, giving some pros and cons, not trying to be too con on our competition, but let's just start with a bank. What's the advantage and disadvantage to a customer going to the bank down the corner with the brick and mortar?
So bank and credit union, we'll use those as synonyms, basically, okay? What happens is it's familiarity. That's where my checking account is. That's where my savings account is. I can go in there and talk to a teller. And there's a convenience factor or a familiarity factor with, well, that's where my payroll check gets direct deposited there. I got my money in there. Of course, they're going to lend me money. So that is one of the things that people go because it's familiar.
And so what would you say is a con to those two types?
So now when you're dealing with that, you are dealing with somebody when you go to get your loan that maybe 1 minute they're processing a car loan, the next minute they're opening up your 5-year-old savings account, and the next minute they're working on your mortgage. So what happens is they become very wide, or they have a broad spectrum. To offset that broad spectrum, they have to have a very narrow window of how they lend money. You're either going to fit into a square, a circle, or a triangle. If you don't fit into one of those, they're not going to do your loan no matter how much money you have in their bank. They don't care. They're very conservative. They have a lot of extra rules. They have more overlays, and typically they are not as competitive as independent people would be.
Okay. I know someone just commented we're having you chopped up there a little bit, so I don't know if there's something you can watch on your end.
Sure.
You can't seem to come back here okay.
All right. Maybe I'm too far from my mic. All right. So that would be your traditional bank / credit union, a pro and a con of that.
Okay. So now talk about a broker. What is a mortgage broker?
A mortgage broker is the middleman. They don't have skin in the game per se. What they do is they take the application. They're not a decision maker. They don't have any authority for the most part. All they do is they take the application and then they're going to place it with the lender. The lender calls all the shots. The lender does all the documentation. The lender draws the disclosures, the documents. The lender does all the underwriting. The lender does all the closing documents. The lender orders the wire. The broker is just the middle guy taking your borrower's application and saying, okay, I can go this, I can go here, I can go here, and has the options in front of them, but doesn't have the control mechanism in front of them. In exchange for that, they do have more options available than like a retail bank or a retail credit union would have. So now the broker's got a few more options. The downside of the broker is they don't have any control. So that lender's like, hey, we're still lending the money. We're still doing all the work. So we're going to pay the broker a little commission. So that gets built into the margin because the lender still has to do all the work. The broker's taking the application and placing it with the lender, and then the lender processes, does the verifications, does the underwriting, does the pre-closing, does the closing, does the funding, the post-closing, and the all that stuff. It's a lot of work still for the lender.
So what something you just said about the word broker, and that is more options, and it made me think back to our overlay discussion, and I see this some with retail compared to the broker world, and that is the loan types. Does any of these types of lenders, are they forced to offer all the loan types that are available out there for people? Uh-oh. You froze, James, if you can hear me. Hang on, everybody. There you are.
Okay. Something went wrong. I don't know.
So let me do the question again, just to make sure everybody hears it flow as well. When you just talked about retail, like a bank or credit union versus this broker, in the broker you said they can all these options. Is a bank or any type of lender type we're talking, are any of them forced to offer all the loan types that are available out there to consumers?
No, they are not. So their business model is proprietary to them. They can structure it the way they want. They can say, we're not lending to anybody, whether you're a red person, a green person, or a yellow person, doesn't matter. If your credit score is under 620, we're not doing your loan, regardless of gender, religion, public affiliation, political affiliation. We don't care. 620 is the minimum. You don't get over 620, we don't do your loan, period. Each lender has the ability to make that own decision for their own business model, their own risk appetite, how they want to conduct their business. They can do that as long as they're not discriminating against the obvious things, religion, ethnicity, gender, that kind of stuff. As long as it's the same for everybody, whether you're red, green, or yellow, it doesn't matter. If that 620 is 620, they can do that. Some lenders like, you know what? We're comfortable going to 580. Some lenders like, you know what? We're comfortable going to 550. Some like, we're just going to go by the basic rules. Whatever Fannie, Freddie, VA, USDA, FHA says, we'll just do what they say. We'll keep it simple. There's more risk in that because typically statistically lower credit scores have a higher statistical chance of defaulting. That's why people put in the extra rules to insure themselves against less defaults.
And then that extra rule, they could just at a bank, let's say, they could go there and the consumer could probably never be told about a USDA loan because the bank doesn't have to offer that either, right? They could just do conventional only.
Correct. You will have a lot of lenders that will not do USDA loans because of the complexities behind it. You have lots of lenders that will not do a WIDA loan because that's a state bond loan. You have lenders that do not do VA that will not offer FHA loans because FHA loans are very complicated and it's very costly just to get approved to even do a FHA loan. A lot of people don't realize how complicated the government makes it for you to do FHA loans. So some lenders like, we're just not going to do them.
So then with the broker, they tend to, like when you said they have more options, does that mean they tend to offer all the types?
I would say that the broker is still subject to the lenders that he works with. So you'll hear brokers say, we work with hundreds of lenders. That's not true. That's an embellishment. They're not working with hundreds of lenders. It'd be too complicated to adopt. Most mortgage brokers have about 7 different lenders, maybe up to 10 that they're doing business with. It's impossible for them to work with over 100. Just the paperwork alone, filling all the paperwork to have an approval with over 100 different people isn't reality. It's an embellishment. It's a marketing thing. The reality is they pick their favorites, who they're going to work with, and they find their niche. They find the ones that are going to help them, and then they work with what they have in their toolbox.
Okay. So we've talked about 3 out of the 5 so far, which I think are the 3 common ones a real estate agent probably has heard the term for: a bank, a credit union, and a mortgage broker. But as you intro this and you talked about 2 other words that I'm wondering how many of them actually have heard this and why it matters, and that is a non-delegated lender and a delegated lender. So tell us about what is those 2 terms, or take one at a time. What's a non-delegated lender?
Let me speak to this for a second, okay? So on one extreme, everyone knows about their local bank or their local credit union. All right, that one everyone's aware of. And then what comes out of that, then there's the broker who goes to the very opposite end of the spectrum, who's independent. Just, could be one person, could be 3 people, whatever. And they are shopping around with different lenders, what they call wholesale lenders, all right, that don't deal directly with the consumer. And the broker places the deal. But then in between that, there's this huge gap. What happens in between the traditional bank, the traditional credit union, and the broker? There's a gap. And that is what we would call correspondent and non-delegated correspondent. There's 2 different business models that fill that gap. The correspondent and the non-delegated correspondent. Let me speak to that. The correspondent lender is going to be captive. That's going to be, so I'll just name Rocket Mortgage is a correspondent lender. They're not a bank, a retail bank, and they're not really a broker. They are a correspondent. They underwrite their own loans. So Fairway would be considered a correspondent lender. Guild would be considered a correspondent lender. Some of the big names that people might be familiar with. Then there's other people that are the non-delegated correspondent, where they do not underwrite. So the differentiating factor between delegated and non-delegated is who underwrites the file. Everything else is the same. So when you are non-delegated, that means you are having an independent company underwrite your loans. It could be just an underwriting company. It could be somebody who's going to be servicing the loan. You can choose as the non-delegated who underwrites your loans. The delegated underwrites their own loans. So they're similar to the bank where the bank underwrites their own loans, but they have a little bit more autonomy because they have a higher appetite for risk because they don't do car loans. They don't do credit cards. They don't do other stuff. They just do lending. So delegated, you underwrite. Non-delegated, you do not underwrite. Does that make sense?
Makes sense to me. So now explain, you said like, here's the broker, here's the bank, this correspondent, delegated, non-delegated in the middle. Now explain what's the difference between this broker and this correspondent, delegated or non-delegated world.
The biggest difference is control. The correspondent lenders, which are delegated or non-delegated, they have control. They're doing the documents. They're doing their disclosures. They are processing the loan. So the delegated are underwriting the loans. The non-delegated are using an independent company to underwrite the loans. They're drawing the closing documents. They're ordering their own wire. They control what I say the manufacturing process of the loan. The delegated and non-delegated controls that process. The broker has zero control. The broker submits it and waits. Nothing the broker can do other than wait. They're waiting for the actual lender to do everything, to do the disclosures, to underwrite the loan, to draw the closing disclosure, the initial closing disclosure, to wait to get a wire, to order a wire. They have to wait, and they're not an employee of that lender. The broker is an independent company that is sending business to another company and waits for that company to do their job. That's why realtors can get frustrated with brokers because they don't have the control. Unlike a correspondent or a non-delegated correspondent, they can walk into the office across the hall and say, hey, I need this wire sent. So there's more control, which allows you to have a better manufacturing process of the loan.
Which in turn would be a better process for the buyer, the borrower, into becoming to own a home.
Correct. It makes it better for the consumer. In my professional opinion, doing this almost 3 decades, when you see the bank model, you see the broker model, that gap that's in between is the best place for the consumer to be. It is absolutely the best place because what happens is they're inside of the correspondent lending model. Remember, there's 2 channels. There's the delegated and the non-delegated. The delegated I'll talk about first, and I'll tell you why I think the non-delegated is better than the delegated. So the delegated is we underwrite the loans. So when we see something and my underwriter digs their heels in because like, I don't agree with you, doesn't matter. They're your coworker. They're your employee. So they work with you, and if they say no, the answer is
no.
And the deal's dead. That's a captive. That's like when State Farm does an insurance policy. If State Farm doesn't like it, the deal's dead. Period. But if you go to an independent insurance agent, it's like, okay, State Farm didn't like it, but you know what? I've got auto owners who I know will do these type of loans that have pools. So that they could take that same customer and ship it to a different company. The non-delegated doesn't underwrite their loans. So if they send it out to an underwriter, and the underwriter is like, no, I don't like it. They can pull that and send it somewhere else and have it underwritten with somebody else who maybe looks at it differently. So they have the diversity and they have the options that the mortgage broker has over here, but they have the strength that the bank has here. So when you see the gap between the two, the non-delegated correspondent is the absolute best place for the consumer to get a loan. Diversity and options of the broker, lots of options, strength of a banking platform. That hybrid model is the best platform for the consumer in today's mortgage market.
So we were talking before we came on, and I kind of mentioned when we were talking to different type of lenders, we were preparing for this. I told the story of I have a loan and I'm in the process, and the underwriter where I sent it didn't. It's a rule that has some gray area to it. And so then I can take it and have another underwrite done. Can you explain that to them, what the business model, why that really matters to their experience?
100%. Let's just use something simple like lawyers. One lawyer reads a statute this way. That same exact statute is read by a lawyer differently. So then they argue about what it means. So then we have a judge that says what he thinks it means. And then it gets appealed because no one agrees with what the judge thinks. So it's the same verbiage for everybody. It's the interpretation of the verbiage. Take that into underwriting. One underwriter reads it like this. And we're like, that doesn't make sense. We just closed the same exact scenario somewhere else. But that was a different underwriter. So now we pull it from that person who's looking at it maybe through a different lens. Why would they look at it through a different lens? Potentially, maybe they approved a loan like this 5 years ago in their career. The loan defaulted and they got reprimanded at work. Why did you approve such a stupid loan? So now all in the back of their head thinking, yeah, I got yelled at from a deal like this 5 years ago. I'm putting my name on that deal. And then you go to a different underwriting company and they're going to be like, oh yeah, we do those all day long. No problem. They sign right off on it. Does that mean the loan officer is a moron? No, it doesn't. Does it mean the processor's bad? No, it doesn't. It's just one person reading the rule one way and that same exact rule, another person reads it a different way. And that happens every day in the courthouse.
And can that movement of a different underwriter happen in the other business models that we've talked about, from the broker to the retail?
So what happens now is if you're in the retail platform and your underwriter says, nope, we're not doing that. The deal's dead. Your customer is not getting a loan from ABC Bank. If you're in the broker environment, they may say, yeah, my lender won't do it. They may have another lender that can do it, so they'll shop it around. But remember, they have no control. So now they're working, and then what has to happen is the customer's got to start all over. It's got to be resubmitted to the new lender. They got to have new disclosures sent out. They got to usually order a new appraisal because they have a different appraisal company. And the whole thing starts all over. And that's why realtors get frustrated, because the broker doesn't have the control or the authority or the power to do it. In that middle, correspondent lending, which we call that's correspondent lending. Correspondent has two channels, delegated and non-delegated. The correspondent lender doesn't have to start over because they're the lender. It's our money. We're lending our money. We're just trying to get an underwriter to see it our way. So we have the option to say, you know what? This underwriter doesn't see it this way, but I know we did this same deal at a different underwriter. We're going to send over there. And it's invisible to the consumer. We don't have to start over with new disclosures. We don't have to redo anything. We don't need another appraisal. None of that happens because we're still the lender. We just need the underwriter to validate what we believe to be true.
Got it. You know, one last thing I'd like to do here before we wrap up is, you know, we real estate agents, we try really hard not to make this series about us. You know, we're trying to provide you information to help you do your part better, but also have some insight into our world. But it's ultimately so that you can help more listings and help more buyers do it. But on this topic, I just asked realtors for a little grace. We want to just talk about us a little more direct and who ProVisor is.
Yeah.
And so one of the questions I told James I'd like to cover is, in this topic of overlays and banking types, we're just going to be transparent and say, hey, real estate agents, we're going to do a commercial right now. James, tell them, what is ProVisor structure and why did you choose it to do business, and why, which ultimately I'm hoping tells the real estate agents on this why they should do business with ProVisor.
So I've worked in all three channels, the broker channel, the correspondent channel, and the retail channel over my long career. So I've seen how loans are worked in the retail channel. I've seen the frustration of saying no to the customer, and I've seen the tears on their face where they just wanted a house. I've worked in the broker channel. I started my own company as a broker. All right. And in the broker channel, I saw the beauty. We were doing deals that the bank said no. Bank would turn it down. They call us. We could get the deal done. But then I saw the limitations for the consumer. I saw that the fees were higher. The rates were usually higher because you got to build the broker commission and on top of whatever the lender wants, because the lender's going to make their money. But the broker's bringing them the deal, but that money's coming from somewhere, and it comes ultimately from the consumer. So I see the strength of that, but I saw it's still not the best model. So then I jumped into the correspondent channel. When I got into the correspondent channel, which is the one in the middle, which is the one that has two different divisions, they have the delegated where you underwrite, the non-delegated where you don't underwrite. So when I was the divisional president of a correspondent lender, it was a beautiful thing, better than brokering loans. But then what I didn't like was when the underwriters dug their heels in, the deal was dead. And I just got frustrated. And we still went back to that banking model. Like, now we still got to tell these people no, even though I know we could get this deal done over here. When you're a captive correspondent lender, it just is what it is. The deal's dead. So the niche that I went after was to have the diversity, the options of the broker, and have the strength and the power of the banker, and have the independence of the correspondent right in the middle. And to do that, I needed to release control of underwriting. So that underwriting, I had to subcontract that out, where they're not my employees. They don't report to me. They're independent of ProVisor. And if I didn't agree with that underwriter, I could say, okay, thank you very much, shoop, and go to a different underwriting company and have them underwrite the deal and get those deals done. And what I saw was our pull-through ratio went up. We were closing more loans. We were helping more buyers get houses with maybe dings on their credit or stories, or sometimes bad things just happen to good people. That's called life. You know, nobody wants to get sick, but when you got to choose between paying your credit cards or putting food on your table because mom has cancer, you put food on the table for your kids.
Right.
And there's a story behind that. And unfortunately, in the extreme channels, they don't care about the story. But when you get in front of a non-delegated correspondent lender, we're going to hear the story, and then we are going to go to work behind the scenes to make that story work, where it's old-fashioned underwriting, and we can talk through it, and we can maybe type up a letter of explanation, and we can document it. You know, I'm sorry, we're going to have to prove that that's really what happened. And then people get the human factor injected back into the process. And that was the reason I launched ProVisor, to bring the human factor into the process so we could say yes to more people and no to less people.
Awesome. Awesome. All right. Well, you've never been the guest until the second half of this. So now I'm going to turn it back to you're the host.
Yeah.
And close it up for us.
Well, I just want to say to everybody, thank you for watching. This is going to go on our YouTube channel. So if you have some people that maybe there's a section you want to rewatch to understand like the different channels of lending or whatever, go on YouTube. This is going to be posted on YouTube here within a few hours. Or if you want to share it with some of the other real estate agents, that would be great. Remember, we're doing this to lead with a giving hand, just to help educate and empower you to make good decisions when you're out in the field. So you're doing what's right for your consumer right now. You want to do what's best for your client. And what's best for the client is when they're educated and they're empowered to make the best financial decision for them. There's a great disparity in fees, pricing, interest rates, and it's important that you're in alignment with people who are doing what's best for the consumer. That's our passion. That's our heart. We do this the second Wednesday of every month at 10 o'clock Central Time. So I would encourage you to take a few minutes out of your day, tune into us again. Next month, we're going to have another exciting topic, and invite your peers, invite your friends or your broker or whatever. If you miss it, it's on our YouTube channel. I just wanted to say thank you for everybody taking time out to watch this today. Ritchie, I'll let you share any closing thoughts and then we'll end it.
I think that was done well. And just remind, real estate agents, we're here to help. You can call any loan officer at our company, and they are going to find the answer for you and help you, whether your consumer is doing a loan with us or not. We want to have a giving hand and make sure that you're educated. So I've never known any of our loan officers to have any other view than what you and I have shared here today. And that is, we're passionate about helping you as a real estate agent get the answers, even if we're not the lender.
Correct. We will serve. We want to be servants. All right.
Yep.
Thank you. Have a great day, everybody. Enjoy the warm weather here in Wisconsin. Bye-bye.